Oil prices have been trending towards the lower end of the $70 US per barrel range over the past several months. Our next guest expects this to continue into 2025 and says the price of crude oil could go down to as low as $60 US per barrel. For more on this and what's in store for commodities in 2025, I'm joined by Max Layton, Global Head of Commodities Research at Citibank. He joins us now from London. Max, thanks a lot for joining us. Let's talk about crude oil. First of all, are you talking about West Texas Intermediate crude, or are you talking about Brent? And why do you see it going down to $60 US per barrel?
Yeah, thanks for having me on. We're talking about Brent prices. By the middle of next year, we see Brent trading around $60 a barrel. The path to get there, may be somewhat choppy, but we've been in a choppy downward range for the last 6 months. And that's something broadly we expect to continue over the next 6 months. The real pressure on the energy market, on the crude oil market, on Brent and TI prices comes, we think, in the second quarter. First quarter, broadly balanced, small surplus, threat of escalating sanctions on Iran and maybe even actual sanctions on Iran or more implementation or more enforcement of those sanctions, of the existing sanctions. That probably means it's a bumpy road lower. But second quarter, we're looking at a 1.5 million barrel surplus in our baseline scenario in the second quarter. And on average, over the course of next year, about an 800,000 barrel a day surplus. And that's driven by really broad-based supply growth across more than 10 different non-OPEC plus countries around the world.
What's OPEC plus going to do with those production increases that it keeps kicking down the road?
Sure, thanks. Our baseline view is that they're going to keep kicking them down the road. We're already assuming that they kick them down the road through the end of next year. We think that, that surplus is happening without OPEC plus bringing back any significant barrels. So, not a lot, obviously no room to bring back those barrels in our baseline view. And look, I'd add, there's a lot of talk about the U.S. economy and whether or not it's outperforming, whether or not it's weakening. And I guess, our take is, and certainly our economists' take here at Citi, is the U.S. has actually been slowing down both the labor market and activity for most of the last 2 to 3 years. And that's because, the economy is being weighed down by 15-year to 20-year high real interest rates, still very high nominal rates. And also there's some budget pressures. So in the face of that broader backdrop of a slowing U.S. economy, albeit very gradual slowing, oil demand growth is probably going to slow down as well. So it's not just about supply, it's also about U.S. growth slowdown, add on to that some tariffs and potentially some budget cuts. And it doesn't look great.
Okay, let's move to base metals. The price of copper has been trading above $4 US per pound for a while now. The market seems to be pricing in a better 2025 in terms of demand, global economic growth and demand growth for copper. I think you're skeptical here as well. Are you on base metals?
Yeah, I think a lot of what's going on now is stocking through the supply chain, whether it's raw material stocking in China or stocking of by end users or pre-buying by end users ahead of tariffs, ahead of RMB depreciation. So our house view is that dollar DXY is really quite strong for the next 6 to 9 months and could even get up as high as 115 in the scenario that Trump really ratchets up the tariffs on China. A baseline house view is 7.7 on the RMB. And that depreciation, that potential for depreciation, is providing, believe it or not now, a tailwind for metals consumption, either through this kind of pre-buying / stocking that's going on that will eventually become a big headwind. We think ballpark around the second, third quarter of next year is when that becomes a big headwind for metals pricing. Ultimately, though, we're really quite bullish medium to long term still on aluminium and copper. And I just highlight that a very small portion of demand in these commodities, which obviously the main base metals or the big two in the base metal space, the vast bulk of the demand in these two metals is coming just from energy transition sectors. And those sectors represent only 20% of consumption, 15 to 20% of consumption. The other 80% is not growing. It hasn't been growing for 2 years, what we call cyclical consumption. It hasn't been growing. That 20% is absorbing 100% of the mine supply. So only a small portion of demand is mopping up all the mine supply and all the refined supply of aluminium and copper. And one day we are eventually, we hope and we expect in the base case, going to have a 50% of consumption. The cyclical part, our base case is 2026 now. We pushed that out almost a year recently. And when you do have that pickup, you're going to have really substantial deficits in these markets. So they're quite leveraged to a global manufacturing and global recovery, which unfortunately doesn't look like it's around the corner.
You've mentioned Trump and the tariff threat a couple times for very understandable reasons. I just want to be clear. I'm reading your notes right now. Your base case is that Donald Trump's posture on tariffs and China is that he's not just rattling his sabers. This is not a negotiating tactic. You say your base case for China tariffs is that those tariffs increase by 10 to 15 percentage points in the first quarter of 2025. In other words, as soon as he becomes president, and for those tariffs to settle in at 60% on tariffs on China, and for China to respond with tariffs of its own. In other words, you see a tariff war erupting between the number one and number two economies in the world, correct?
It's certainly correct on the doubling of tariffs, or the roughly doubling. So tariffs on China, US tariffs on China, and certainly correct on the first quarter. Whether or not the follow through is on the 60%, that's not our base case, but there is certainly pressure both to raise funds to meet spending commitments or pledges made during the campaign, and given the budgetary pressures that are ongoing in the US with the $200 billion increase in interest costs every year for the past 3 years for the government in the government interest or the government balance, to raise money. So it's possible the 60% happens. It's not our base case, but certainly current average US tariffs on Chinese goods imports are at 12%. It affects about 2/3 of Chinese goods imports into the US. A baseline view is that those 2/3 of goods that are currently affected by tariffs, roughly those tariffs double, taking the effective weighted tariff to about 25% in the first quarter. Okay, we are short on time, but I don't want to end our conversation before we get your view of gold in 2025. Yeah, I think it's a very bullish setup. The US has been slowing down for a couple of years now. It's going to keep slowing down over the next 12 months. And while that's the case, until US growth puts in a bottom and until we're sure we're at the neutral rate of interest rates and we can think about an upturn in growth, till we get there, we're going to have people buying a lot of gold as a hedge against downside in equities and broader asset price downside risk linked to the US economy. Secondly, we have a lot sustained strong buying by central banks. And the combination of these two things through we show this in a fundamental physical framework for gold pricing, which we published and developed over the last 6 months that does not break down like real rates models. We use this model to actually, relatively scientifically come up with a $3,000 price forecast for gold over the next 6 to 12 months.